Today's video is part 3 of an interview I did with radio host and financial advisor Josh Jalinski, where we discussed whether or not you can be too rich to get to the 0% tax bracket, how to avoid IRMAA with Roth Conversions, and whether or not you should do Roth Conversions in your 70s and 80s. So sit back, relax, and enjoy part 3 of my interview with Josh Jalinski.
A lot of people think, well, David, I make too much money to do these strategies. That sounds great, but how do I really get in the zero bracket if I'm, if I get $1 million in cash or $1 million in an IRA, how do I get to zero? And you break it down in Power of Zero. They actually can, but a lot of people don't realize that they can.
Yeah, I actually had a lot of people come up to me and they say, "Oh, Dave, I got $1 million in my IRA, so I'll never get to zero, right? I'll never be able to pull this off." And I say, you got to read the chapter, I think it's chapter 6 of the updated revised version of the Power of Zero. It's called The Tax Sale of a Lifetime. There's a sweet spot in the Trump tax cuts that people often overlook. It's my very favorite tax bracket. It's 24% tax bracket. If you're in the 22% tax bracket, Josh, let me back up and say, if you're in the 12% tax bracket, and I warn you that tax rates could potentially double in the next 10 years, and you say, okay, but you want me to bump up into the 22% tax bracket to protect myself from that? What have I basically told you? I basically told you I'm going to double your tax bracket in the short term to avoid a doubling of tax rates for you over time. That's not something that most people really get warm and fuzzy about. However, if you're already in the 22% tax bracket, why not convert your IRA to a Roth up to the top of the 22% tax bracket? By the way, the 24% tax bracket is only 2% higher, but it allows you to convert an extra $170,000 per year. So between the 22 and the 24% tax bracket, you could convert $250,000 per year and still be at a tax bracket that's lower than the future version of the 22% tax bracket, which is the 25% tax bracket. So we have this window of opportunity during which to take advantage of historically low tax rates. I do personally believe, Josh, that they're going to extend the 22 and 24% tax brackets for the middle class, and I think they're going to do it before 2024, certainly before 2026. I think that politicians that don't do that will be perceived as having raised taxes on the middle class. That's not something they want to be perceived as having done. And so I think that's going to happen, which means get $1 million in your IRA. You could potentially have 8 or 9 years during which to take advantage of the 24% tax bracket, which would allow you to convert 24% or $250,000 per year and still stay in this insanely low tax bracket relative to what we've seen in history. So there's all sorts of opportunity to get to tax-free, and every year that goes by where people fail to take advantage of these historically low tax rates is potentially a year beyond 2030 when they could be forced to pay double the rates.
And I would kind of link with that Medicare taxation, because if you have everything tax-free, you're going to have lower Medicare taxes when you're 75. IRMAA, the dreaded IRMAA, you want to talk about that? IRMAA planning's big right now.
Yeah. So this is one of the number one complaints that people have about Roth conversions, as they say, "Hey, Dave, if I do a Roth conversion over the next 5 years, my IRMAA payments are going to go through the roof. They're going to get really expensive. And is it really worth it?" We actually have a calculator where we actually show them the IRMAA they would pay if they just left the money in the IRA, and how those increased IRMAA payments, they just get bigger as the RMDs get bigger and bigger and bigger. They just get bigger and bigger and bigger over time. And then we add up cumulatively how much increased IRMAA premium they would have to pay over their lifetime versus having to pay just the increased amount over the 5 years and then just the normal premium from that point forward. And you know what? It's not even close. And then if you add in the Social Security taxation that you have to pay by having to, take those RMDs over time, and you add that to the increased IRMAA payments, it's not even close. And so, it's sort of like Ed Slott says, you got to rip the Band-Aid off. And if you rip the Band-Aid off, then you'll be all the better for it.
So as it relates to IRMAA, which is the income-related Medicare adjustment, your ugly Aunt Irma that you don't want to come visit you. For some reason, the time that people should do this LERP planning and IRMAA planning is in their 50s. And then they kind of wake up and they realize they should do it when they're 65. Why is it so important for people to wake up? If you're 50 and over listening, why should people do this planning at 50 instead of just 65? Now, if you're 65 or 70, it's not too late. You should still do it. But talk about sort of the age people, because when sometimes people hear this, they say, oh, I'm too old. And then other people say, I'm too young. Kind of break down, what should a person in their 40s do, 50s, 60s, 70s? Like a life cycle approach.
So are you talking about like the timing of Roth conversions?
Yeah, like what I've found is in applying your work, Ed Slott work, other researchers kind of saying the same thing. Sweet spot's like 50 to 65 because you don't have the IRMAA even to deal with. So it's better to do the Roth conversions when you're still working and in your 50s, early 60s, and when you wake up, unless you're in a really high tax bracket from 50 to 65 and you retire at 65 and you're going to be, let's say you have a lot of passive income, stuff like that.
Yeah, I think if you're still working, obviously you haven't taken, you're not taking Medicare yet, and you're in the 22% tax bracket. A lot of Americans that come to our workshops and come into my office, they're in the 22% tax bracket. They've done a really good job saving. They've saved 10 to 20% of their income over a long period of time. So they got $1 million or $2 million in their 401ks, but they're in that they're middle class Americans. They're in that 22% tax bracket. For those people, it makes a ton of sense to convert to the top of the 22, and then for 2% more, convert to the top of the 24. That makes a lot of sense because you get all the heavy lifting done, number one, before tax rates go up for good, but number two, before you have to start dealing with IRMAA. The flip side is if you wait until you're 65 to do your Roth conversion, you could be in a lower tax bracket, potentially. But you have to weigh that against the potential of paying higher tax on your IRMAA and paying higher tax on your Social Security while you get that money transitioned to tax-free. So I would say that if you're currently working and you're in the 22 or even 24% tax bracket, it makes sense to start executing that Roth conversion while tax rates are low and while you're in that low tax bracket.
What about people in their 70s or 80s? They say, I'm too old for this. It's funny, we had Ed Slott on, and we had a listener. Either you or Ed Slott on, and we had a listener who was in her 80s and 90s, and Ed was like, don't worry about it. Spend your money. You're going to. But he didn't realize these were my listeners. These are New York, New Jersey. People listen to WR. They're frugal. They're clipping coupons, even though they have $2 million. What he should have said, and I corrected Ed because he didn't know my audience as well, even though I think we both got our start on the same basic station, WOR. My theory was, I want you can disagree with me, it's okay. But my theory was if you have an 80-year-old and you're not and you haven't spent it by now, you're probably not going to spend it. So it would be far better to do the conversions, the Roth conversions from 80 to 90, even though they've changed the law with the Secure Act. Because Ed was kind of like, the Secure Act, now they got to spend it. You know how he is. He's like, it doesn't matter. Just spend your money. You're 80. Enjoy yourself. Eat the birthday cake. Go for ice cream. But he doesn't get it. They're not doing it. So my point was, because I know our listeners a little better, from 80 to 90, do those conversions. And because they're at a lower bracket, maybe they're at 12 or 22 or 24, their kids are in a 37% bracket because their kids are very successful. And your kids could have 10 years of tax-free compounding with the Roth or with a LERP. You could buy a LERP on your kids and they could have 80 years of tax-free compounding.
Yeah, there's two considerations, I think. One is this is what I call the quadrupling of tax rates, Josh. If you're married and you're 80s, there's a good chance your spouse is going to die pretty soon. That's just the actuarial table.
70s,
right?
To be honest, people are dying at 77, 78. Yeah.
Yeah. So your spouse is going to die, and what happens to your tax bracket? It contracts by half. So all of a sudden you're spending the same amount of money, but you're paying twice as much in tax. So that's an issue. The second issue is that we're still, if you're going to be alive for 10 years, you're still under the gun when it comes to increasing tax rates. You could still potentially be exposed to higher taxes down the road. David Walker, former Comptroller General of the federal government, predicted in his book, Come Back America, that tax rates would have to increase to a 45% effective level across the board by 2030 to keep our country solvent. So if that happens, then you're going to be able to spend as much, much less of that required minimum distribution as you thought possible. So not only did your tax bracket double, but taxes themselves doubled. So there's your quadrupling in tax rates. And then if you don't, like you mentioned, Josh, if you don't pay the tax today at these historically low tax rates, then your kids are going to inherit these IRAs and be forced to spend it down on top of all their other income at their highest marginal tax rates at the apex of their earning years when they can least afford to pay the tax, when tax rates are likely to be much higher than they are today, when they've got fewer deductions to be able to pull it off. So generally speaking, doing the Roth conversion for people in that situation almost always makes sense.
Okay, folks, that was the end of part 3 of my interview with Josh Jalinski. If you want to learn more about how to shield your retirement savings from dramatically higher taxes, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.